Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. Remember, we are still doing our swag giveaway all month, and I love the enthusiasm in the comments, and thank you so much for your subscriptions. We're so close to 20,000 subscribers on YouTube alone. Help us get there. All you need to do is subscribe and comment, and we will pick. Actually, I've been picking a lot more than just one per episode, and you could get some of our Finance Mean swag. Now, in this episode, it is all about public real estate companies with somebody who started his fund in 2008. So he's been at this for a long time. Jeff Olin is the founder and the CEO of Vision Capital. He's got a knack for finding companies that end up getting taken over at premiums, and his track record is quite successful, especially when you compare it to the index. So without further ado, let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Jeff Olin, thank you so much for joining me on the podcast.
Thanks for having me.
So Vision Capital, you focus just on real estate?
Just on real estate, just on publicly traded real estate securities, primarily equities and debt. And we're long and short, so our strategy is not reliant on being bulls for real estate. We seek to outperform irrespective of real estate supply and demand fundamentals, which we call our blood, or valuations. And we seek, where relevant and appropriate, to be active, value-add, strategic investors. We prefer not to be hostile. It takes you 30 years to build relationships. You can damage them one day, but the funds which have been going, we're now in our 18th year, have benefited from 22 takeovers in our portfolio holdings in the last 17 years at an average premium of 28%. So that's a little bit about the big picture strategy.
Well, I love that. And so you're really clearly saying you're not a perma bull. You're looking for those opportunities. You'll go short when the market maybe dictates it. I think the fact you said you've been in this business for 18 years, if people do the math, that means you started the fund in 2008.
Yeah, we launched July 2nd, 2008, so we missed a good part of 08. And little do we know was about going to befall us in the fall of 08. But we persisted, we prevailed. Their funds are up about 400%, which is about a 10% CAGR over 17 years. We don't use any long-side leverage. The absolute returns are good, but our risk-adjusted returns are pretty compelling.
So for someone who spends their life in real estate, in public market real estate, how do you think about the role that it plays in your portfolio? Like, I think a lot of people, Canadian investors in particular, they know that mining or commodities can offer, it's a risk, but you can really, forgive the analogy, but you can strike gold and you can get these like 10 baggers, these 20 baggers. I don't think that's why people come to real estate. Like, what do you think of the role of real estate investing?
Firstly, in terms of our strategy, most of our investors are not in the get wealthy business. They're in the stay wealthy business. So, this is a sort of a hybrid between a bond and equity where you have the stability and cash flow. So we pay a 4.5% distribution, for example, which is pretty tax effective. So you get that income, but you also have the potential for capital appreciation. Our principal risk metric is don't lose money. We've been doing this 17 years, 16 positive years, and the one negative year we beat the index by 1,000 basis points. So 7 to 10% returns, don't lose money. That's where we fit. Real estate generally should be, in most analysts' view, a core part of your portfolio. The advantage of what we do, of what I used to do, or those that buy real estate directly through bricks and mortar, is we seek to buy real estate cheaper in the stock market than one can in the property market. So by definition, you can't do that in the property market. We get geographic diversification. You get property type diversification. You get transparency, corporate governance. Critically, you get liquidity. And we've seen, you read the newspapers, even maybe you do it online, whether it's the Wall Street Journal or the financial press, whether it's, Blackstone or Centurion REIT or Hazelview or KingSett. I'm not picking on anybody. This is public information. They have gated their investors. Anytime you have a mismatch in any asset class between the underlying liquidity of what you're investing in and the liquidity you promised your investors, those are accidents waiting to happen. And that's one of the advantages of our strategy.
Let's talk about that because you mentioned that you are, looking for these opportunities. Are you bullish right now? Would you say generally? I know you're long and short, but right now, are you
we have some conviction right now. We're bullish on 4 or 5 themes, which maybe we can unpack. But bigger picture, excuse me, new supply has fallen off a cliff. Whether it's a good asset class, a bad asset class, the combination of inflation over the last few years, replacement cost values have gone up, interest rates high, made construction cost financing high. Then you have tariffs adding to that. Then you have crackdown in immigration in the United States, so the cost of labor is tough. So it's tough to make new development work. As I touched on, supply and demand is our blood. Some of the cliches in your real estate we believe are nonsense, like location, 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 we think is ridiculous. Interest rates are important, but they're always exceeded in importance by supply and demand. And you have new supply coming down, and certain asset classes, demand has been resilient. So we're pretty constructive in select asset classes today.
So I want to dovetail that with what you were saying before. I think people will read about what's happening in real estate right now. They'll see all these funds that are gating redemptions, meaning if you want your money back from some of these private real estate funds, they're saying, we can't give it to you right now. Not because there's necessarily a problem with the underlying asset. Sometimes it's just people are panicking, and so there's too much redemptions, and that becomes a problem with the fund. If you look at the condo market, I think we're probably going to see a lot more bankruptcies. At least that's what I'm hearing kind of rumbling under the surface, and I'm sure you know better than I on that. So how do we reconcile that? Those terrible, terrible headlines, immigration coming off, that being like a big tailwind for demand, immigration's coming off. How do we reconcile that with where you're seeing optimism?
Because, big picture, there's 16 different property sectors in the US REIT index, and then there's subsectors. So shopping centers, you have power centers, and you have strip centers, et cetera. So today we're constructive, significantly constructive on 4 major themes. We like grocery anchored shopping centers where the anchor is a Loblaws in Canada or a Publix or a Safeway. And the balance of the tenants are necessity-based retailers, no fashion. You can't get your hair cut online. You can't get your dry cleaning done online. So this is a stable sector, and new supply has come really down, so you have growth. So that's one area you can get it. We like seniors housing. No tariff risk, no recession risk, demographic tailwinds, everybody understands. New supply has come really down. The occupancy went way down in the pandemic, and it's recovering nicely. We like it in Canada and the United States. Canada looks way cheaper. We like data centers. This was a top attribution to our fund last year. We sold a lot of it, and we had this great re-entry point with this DeepSeek AI head fake. But this is powerful growth. Everybody understands the demand side, but in the last 3 years, people now understand the supply constraints, access to power, abundance of affordable power. Municipalities figured it out. They're putting moratoriums on new data center developments, so rent growth is significant. We like that sector. And finally, probably the best property class over the last 50 years of manufactured housing communities. Let me explain it for you.
Mobile homes.
Mobile homes, but it's a bit of a fallacy that they're mobile. So you go and you spend $200,000 to buy a prefabricated manufactured home and you put it on their land. They charge you land rent, $200 to $400 a month. You pay the property taxes. You pay the operating expenses. It's the most pure form of cash flow in the real estate space. Never had 12 months of declining NOI, including the Great Recession.
Net operating income.
Thank you. We try to avoid buzzwords. Net operating income, profitability, credit. Who's not going to pay their $200 a month land rent at risk of losing their single biggest asset, their home? It's affordable housing. Typically trades because of the fundamentals at a premium to net asset value. We love the fundamentals, but that's not what we want to do at Vision. We don't want to buy at a premium. We want to buy a discount, and we've been able to buy in a discount.
Okay, so the 4 sectors that you like, grocery anchored, seniors, data centers, mobile homes. I want our listeners, our viewers to just hang on to that because we're probably going to get some ideas in that vein. But before we get into stocks, because we got so many questions for you about stock specifics, you also touched on something, the number of exits you've had. Your M&A track record is pretty stellar. And first tell me how you think about that as like a source of outperformance generally. Are you buying a stock sometimes because you think it will get taken over? And what is your spidey senses around M&A? Where does your edge come from?
So firstly, we don't buy securities typically reliant on M&A. It's a bonus. But the difference between real estate and any other asset class is the size of the private property market dwarfs the size of publicly traded universe. Big universe, $2 trillion publicly traded universe in North American real estate. But there is an arbitrage between the two. That's what's unique about real estate. We say we'd rather not compete with Blackstone. We'd rather sell to Blackstone, which we've done on 4 occasions over the last 5 years. Blackstone's figured it out. They bought 53 REITs. I think it's more, actually, 54 now, since they launched the real estate group. I mean, you just look at the last, couple of years here in Canada, right? So beginning of last year, they bought Tricon in the U.S. single-family rental residential business at 30% premium. This year, they closed on the acquisition of Retail Opportunity Investment Corp, grocery-anchored shopping centers, West Coast U.S. at a 34.5% premium. They've been very active in the space. We're the exclusive REIT alternative fund for JP Morgan's wealth management platform. And one of our advisors at JP Morgan called us up, my head of sales last quarter. He said, you guys are kind of like the farm team for Blackstone. I think it's a compliment. I'm not sure. So, that's what's different about our asset class. Now, it's not, sometimes you have controlled entities where there's not going to be activity. You can have value traps for 80, 90 years. We've seen that in our space. Mm-hmm. But that's the difference. And you're not going to get that hurt on the short side. It's not Google, right? You're not going to have takeovers at 200%. We can debate value, but it's going to be plus or minus typically 25%.
That's so interesting because one of the recent transactions, InterRent, I think a lot of people were disappointed that it wasn't at much of a premium. And by some numbers, it was maybe a little bit of a discount to the net asset value. What did you think that was about? And I think, would you extrapolate that just given the environment that maybe that's the environment that we're in, that we're not going to see these juicy deals?
No. I mean, firstly, InterRent specifically, we did hold that. It was the takeover price was exactly within 3 cents of our net asset value. IFRS is a flawed metric. So IFRS is what you're referring to, International Financial Reporting Standards, which one of the difference between Canada and the United States. United States, they still have GAAP accounting. 2011, we started IFRS. And the theory is that every quarter, these entities publish a market valuation of their assets. And it's supposed to be on arm's length market terms. If you look at every takeover that's taken place in Canada since IFRS came into fruition, you see about an average premium of 15 to 20%. So Summit Industrial REIT, in the worst credit environment since 2008 in November 22 took place at a 30% premium plus to their IFRS value and about 20% premium to the stock price at the time. So generally they've been at premiums, but these are lagging indicators. I mentioned at the outset, supply and demand. We use that to assess forward-looking valuations. IFRS is based on appraisals, which are lagging indicators. Whether markets are going up or down, they're lagging indicators or they don't exist. So, we go back to the private versus public. Fourth quarter 2022, which had the worst 6 months ever for REITs. U.S. REIT index in the fourth quarter was down 28%. Private REITs reporting up 13%. There was a 41% gap.
Why?
Because I have to account to my investors every day at 4 o'clock. Private REITs get to self-report, but appraisals don't exist. They're at 18 to 24 months old. The question was and is, which one was right? And we said both. In some cases, the stock market got it right. Go back to Summit Industrial REIT. Took place fourth quarter 2022. Other sectors, the stock market got it wrong. Our top 5 attribution to our fund in 2022 were 5 shorts on U.S. office REITs. Lagging indicators, there's a hesitation. I mean, you look at the major Canadian pension funds that own real estate. You know them all, Ontario Teachers, OMERS. I'm not going to pick on anybody. Look at them all. For over a 5-year period, they had a total return of 40 basis points to the end of 2024 on average. They're lagging indicators. They don't, if Ontario Teachers, in my opinion, mark the market, the value of their office buildings in downtown Toronto, people are going to lose jobs, right? And it becomes a bit of a dysfunctional market because there's a reluctance to lease at market rates, because if they lease at market rates, then their auditors are going to force them to mark down the value. So you have slow moving.
So they'd rather have open space than unleased space than leased space.
It's a bit of a cynical outlook. But yeah, I think that's a factor. Talk to leasing brokers. They get frustrated.
Let's stick with that kind of problem child in office. We interviewed Michael Cooper of Dream Office and kind of the Dream complex, who for the first time actually sounded optimistic about what was going on in office. And in some cases, you're seeing office REITs start to rip up again. And I wonder to what extent you believe in that rally, you're participating in that rally as office, because office wasn't one of those 4 categories.
No.
So I'm curious how you think about office right now. There will be a time, I assume, to get into it. When is it?
We're big picture, we're fairly neutral on office today. There's been a big movement in the office REITs because of sentiment, return to office, and it's real. And it's part of it is not just people returning. There's some growth because there's been hiring over the last 5 years. And so people are returning to the office selectively. Mm-hmm. I think TD Bank has been talked about is, they don't have enough desks because they've hired, they've grown. The sentiment has got ahead of the stocks, in our opinion. We're bullish on New York City. Return to office has been there for some time. We're less bullish on Canada, but the sentiment is strong, and we're neutral on the space. It's real, but we're not. It's a tough business. I grew up in the office business with 2 large North American developers, and frankly, I've never seen anybody in history ever make money with get a reasonable return with a buy and hold strategy in office. And the reason is the capital expenditures. And it's not the lobby renovation or the parking garage. It's the tenants. Every time you lease that space, you got to give them free rent and tenant improvement dollars. So yeah, I think, Michael's Dream Office REIT looks reasonably good right now. Certainly a lot better than it has. But, people were saying, interest rates had a big tailwind in, the mid 2000 teens, 2013, 15. Well, in that environment, at the time we were disclosing our shorts, we were short Dream Office REIT because even though interest rates were coming down, they had 42% of their net operating income from Class B office buildings in Toronto. and 27% for Class B office buildings in Calgary. And there was like 7 million square feet of new office space being built in Toronto and 5 million square feet being built in Calgary and Edmonton. At the same time, well before the pandemic, demand was down because between 2000 and 2020, the lawyers don't have law libraries anymore, right? Deloitte built new buildings in Toronto to Montreal. They went from 300 square feet per employee to 160 square feet per employee, no office or partners. That was already going on before the pandemic. Less demand, too much supply wasn't a good recipe. And then you add the capital expenditures, tough business generally at all times. So we're always cautious, on office, but right now we're neutral. We're long New York. We're constructive on Sunbelt, US. We're cautious on Canada because valuations have really got ahead of itself. And we're cautious on the West Coast US.
What are you doing? How are you viewing the condo market? A lot of that is private, and so maybe it doesn't really touch your world. So either thoughts as an investor or just an observer who's watching what's going on in condos.
So I thank God there was no significant or any public companies focused on the condo market in Canada over the last 15 years because I was wrong for 12 years. I mean, like so 15 years ago, you could buy a condo, you could pay your monthly maintenance fees, you could pay your property taxes, and you had some money left over to pay your mortgage. Well, that hasn't been the case in Toronto for a long time. People say, oh, well, that's okay. It's Toronto, property, we got capital gains. And that was true for a long time until it wasn't, and it is not. So it's a challenge. The investor market is gone. It's going to be a long slog in terms of the condo market. Now, we're right, but it still has no impact. Where it has impact to what we do and to your audience, other than directly the condo market, which I'm sure it impacts a lot of people, is apartments. It's the shadow supply for rental apartments. So it's hurting particularly in this marketplace because the condo inventory is generally higher quality than a lot of rental stock. And it's hurting that supply demand dynamic for rental apartments.
Which means you're kind of staying away from it.
We're cautious on apartments in North America. United States, demand is strong. There's oversupply. Canada, it's demand challenge to shut down immigrant. What we like one name, Boardwalk, which is Western Canada, and Mainstreet. We like both. Mainstreet has been a value creation machine for 30 years. Amazing story. Boardwalk is 72% non-rent controlled markets. Alberta, Saskatchewan, and it's affordable. The rental level they have is well below the rents that the new construction requires, whether it's a purpose-built rental or renting out a condominium. Generally, the rental levels are much higher. And so that's our real own but we're cautious on the rest of the country. We've been in a per capita recession in this country for 2 years. The reduction in immigration numbers, we're not constructive on the political wins here. I don't want to get political, but we're cautious.
You can, it's a podcast.
We're cautious on Canada generally, and other the asset classes we love, we think are going to do well in this environment.
Okay, well, this segues perfectly into the mailbag. We've got a lot of questions on a number of these sectors. Okay. Let's get into it. Okay, so our first question in the mailbag, actually our first two, is related to what we were just talking about, the apartment market. A Canadian Apartment REIT, of course, we have to talk about. We got a question from the real Salukan on X. Canadian Apartment REIT is down 10% in 5 years, despite the Toronto real estate boom since COVID. What is going on with this company? In fact, over the last year, it's done even worse. It's down about 23%. You were just saying you really only like Boardwalk in the space, but is there anything in Canadian Apartment REIT that would make you constructive?
We like Boardwalk. We like Mainstreet, also Western Canadian focused. Listen, CAP REIT, good operating team, good management. Firstly, let's talk generally apartments. One of the challenges relatively to commercial real estate is the rent is structured as gross rents, not net rents. So what does that mean? If you're office, retail, industrial, the tenant pays the proportionate share of operating expenses and property taxes, not in apartments. It's gross rents. You pay your monthly rent. That's what you pay. So when you have most of the markets in Canada with rent controls and your revenues are limited, but your expenses are not, and they've been subject to inflation, that's a challenging recipe. Then you add some of the demand impingement that we've talked about. Immigration reduction is a big factor. The reduction in the student population is a big factor. The shadow supply, heavily in Toronto, from condos that are having a tough time getting rented. Demand is impinged. You've had some purpose-built supply that's taken place. CAP REIT in particular, they've done, I think, a reasonably good job about high grading some of their portfolio. But now those rents are at the same level that's hitting that condo shadow supply. So we're cautious on that from a supply and demand perspective.
Just to reiterate, I mean, you keep coming back to that point, supply, demand. You know, we haven't talked much about interest rates. We haven't talked much about tariffs. They've come up, but it's so fascinating. It all does come back to your North Star. What did you call it? The blood?
Supply and demand is our blood, yes.
It's your blood, yes.
Yes.
So you're really proving it in your answers here. You've mentioned Mainstreet Equity a few times, and we got a question actually from Sachin. Could you please ask Jeff for his long-term outlook on Mainstreet Equity? I'm considering it as a 20-year investment and would value his thoughts on key growth drivers here. And I think that time horizon is important because Mainstreet Equity, since it's been public, has been just a home run, and it's a different kind of beast, right? They don't pay dividends, they reinvest. And we did an in-depth interview with Bob Dylan, the founder and CEO. So you can catch that. Search in wherever playlist you're listening to if you want to know more about the business. So I say it's had tremendous growth because over the past year, it hasn't really done anything. So you have this moment where it's kind of pumping its brakes. And I'm curious what you think is behind that and where you see it over the long term.
Bob's amazing. His business model is amazing. Full disclosure, I had the privilege of my former career as investment banker, I think it was 2003, leading the only equity-related financing that's ever taken place for Mainstreet. So this is an entity that's grown from like 900 apartment units to, I don't know what their number is now, close to 20,000, with $10 million of net equity capital. My partner and I helped them raise $33 million for them. The stock was $4.50. It was a convertible debenture at $6.25 a share, 2003. And in 2009, he bought back $25 million of that in the tough times. So $10 million of net equity have grown this enterprise to 20,000 units. Corporation, not a REIT. Reinvests the capital. He's, as you recall from your podcast, the Mainstreet value chain. He, buys physically challenged units, puts capital in them, fixes them up, makes it better for tenants, releases them at higher rents, takes out his cash flow, his increases the cash flow, refinances them, takes out a lot of his equity and does it again. So I don't know about 20 years. Yeah, you own it 20 years, you're going to make a lot of money. Look at the last 20 years, $425 to $200.
Yeah.
Pretty good return. I'm not saying it's going to be the same return over the next 20 years. I don't think you're going to have to wait 20 years, but you hold this name for a number of years. I think you're going to do really well. Bob is an entrepreneur. He's highly aligned, and I think and others are jealous of his business model. All the REITs that went public, and they're reliant on putting out cash flow and reliant on Bay Street to raise new money. Bob's never done that.
And never sold a share.
Never sold a share.
Which is wild to consider over 25 years. And yet the stock is waffling. It's consolidating. It's not that, nice trajectory upward if you bought it in the last year.
Hence your viewers frame is appropriate. I said, I don't know about 20 years, but you hold the stock for the long term. I think you're going to do fine.
Another spicy file we got a question on is from TSX Man on X. What do you think the outcome will be of the H&R REIT strategic review? We're now about 7 months into it. He criticizes the CEO in how it kept that process hidden from unit holders until media brought out the story. There's activists on the file, which we've interviewed. What do you think about H&R? First, let's talk about what it is as a business, and then we'll talk about the street.
So H&R, and one of the challenges of H&R is that it's a complex enterprise with different multiple property types in multiple geographic regions. So
it's not a pure play.
It's not a pure play, and that's one of the inefficiencies that we take advantage in our space. Is we look at times because there's 70% of REITs in Canada owned by retail investors. 80% of REITs in the United States are owned by institutional investors, and the majority are made up of what is affectionately known as the REIT mafia. Think Fidelity, Cohen and Steers. These folks have their performance benchmarked to the REIT index as one inefficiency, but another one is they want pure play investment vehicles. They don't want management teams to decide on their behalf to invest in office, retail, industrial apartments. Well, that's H&R. They have some great assets. They have some great apartments in the Sun Belt of the United States. They have some great industrial properties, a lot in the GTA here. But they also have a bunch of office buildings in Toronto, in the US, and they have this large single tenant retail portfolio, which they don't control. They've been trying to get liquidity on for years. So it's a mishmash. We don't own it. We are skeptical that they're going to, I think it's likely a transaction does occur. Likely, not highly confident, but likely. We're not confident that's going to occur much higher than the current share price. And it might be a complex deal because some of the buyers don't want some of these assets. So it's going to be what's known in capital markets as a club deal, likely.
What's a club deal?
Club deal is when different buyers team up to buy different parts of an enterprise. We think part of the way to get, maybe it's $13, $14 a transaction, but that
stock's at 12 for context.
Stock's at 12. That probably only happens because there's a tax liability here. So unless there's a creative solution to defease the tax liability, you're probably not going to hit those higher levels. The risk reward for us is not high. We think this is around $12.50 is probably fair value. If a transaction doesn't occur, you might see the stock go back to $10. So we're not playing. We're reluctant.
All right. So you're watching this from the sidelines.
Yes.
We got a question. It's on two stocks from Nugget Capital, and they do a lot of work in the REIT space on X. They note that your fund's top holding is AmeriCold, which is a sector worst performer. Do you consider an activist approach on such horrible management performance? Again, I'm quoting this report. Also, your fund has Allied Properties as a top short. Nugget says they think they have to cut the distribution, which they haven't done, by the way, even during the pandemic, and it's an office REIT. Is that also your short thesis? So I feel like we should take these separately. Yeah. AmeriCold is a totally different company from Allied. AmeriCold specializes in temperature-controlled warehousing and logistics. It is down bad, I think, at a record low.
Yes, it is. So let's fact check two things on AmeriCold. One, it is not one of our very largest holdings. Secondly, more importantly, we are net neutral in the space. Yes, we own a meaningful position in AmeriCold, but we are short a cold storage operator of scale in the space. For us, most of our short positions are not so-called alpha trades, like I mentioned, Dream Office REIT between 2013 to 2017. That was a high conviction, supply and demand driven, valuation, secular change story. Most of our short positions are part of long, short, paired trades, where in order to consider the performance, one must consider both the long and the short. in terms of the attributions. So I remember we had one trade on 12 years ago. We were long at that time, 15 years ago. We were long H&R REIT. We were short a REIT at the time called CREIT. One time they both went up in price. Our funds made money because the long went up more than the short went up. One time they both went down in price. And we made money because the long went down less than the short went down. One time was a perfect world. The long went up, the short went down. Now, we could have lost money if relatively the long went down and the short went up. I'm not sure that's happened once in 17 years. So, yes, AmeriCold has been a dog, but we have defeased that with a short against it. And today, what's wrong with this sector, and it's not an enterprise. Management's done a good job. They've increased margins. It's in the cold storage area, which from real estate space, the good part is there's not too many real estate asset classes where investment circles, you talk about a moat, barriers to, there's a moat around cold storage. You can't just build a cold storage facility. You need to have global food processor, food distributor relationships, et cetera. But the demand has been down. Tougher economic times, the demand for freezer activities has been down. Cold storage has been down. That's what's really hurt this. It's not an enterprise-related issue. It's hurt the whole sector.
So because you're paired your long against a short, you're not necessarily even saying this is a buy the dip opportunity.
Yeah, I think if you did our view on net asset value it's probably north of $20. The stock, I don't know, was around $13. It's really cheap for this asset class. So really, it's one's view of the demand side. It's not really a supply problem here. It's hard to build these on spec. Some people have done it, but if you don't have the tenant relationships, that doesn't make a lot of sense. I think you can buy AmeriCold at these levels. There's a nice dividend. You do quite well.
That's safe? You think that yield is safe? It's a 7% yield.
Yeah, I think it's relatively safe, yes.
Okay, let's tackle Allied. An office. It's kind of unique office spaces that they have. So not your towers and the like, but, a lot of these edgy brick sort of buildings obviously got crushed after the pandemic. Unlike others, I don't believe they ever cut their dividend, ever cut their distribution. They've been increasing it slightly. And with the return to office, it started to run up. And the question is, what do you do with a stock like that?
So they should have, they need to, and in our view, they ultimately will cut their distribution. They've been dramatically overpaying their distribution. They've been rationalizing it based on capitalizing interest. So interest that is real, they got to pay it. It's draining cash, but they're allocating that interest to developments that haven't come on stream yet. So it's not hitting their reported accounting treatment. They had a decision to make last year whether they cut that distribution or they're going to be impingement on their investment grade credit rating. Stunningly to us, they chose to maintain the distribution, perhaps to influence retail investors. But, they had an impingement on their investment grade credit rating.
Can they get away with it? If office comes back, you think they can get away with it?
I think it's inevitable. They've been kicking the can down the road for some time. For example, most recently, they've had in the marketplace an expectation that they put out there that one of the ways they're going to maintain that distribution is achieve 90% occupancy by the end of 2025. To quote one of the analysts on the street, there's a 0 chance that's going to happen. I think the CEO has now virtually acknowledged that. They haven't changed that expectation. It's stunning to us. I think they're around 87%, and I'm not even sure that's accurate because some of the same store stuff they take out because they're capitalizing it. So I'm not even sure that's the actual occupancy.
And in real estate land, like if I was getting a grade and I was shot for 90 and I got 87, I would be happy with that. But in real estate land, a 3% delta is
a big issue, particularly when you're relying on that to pay the distribution to investors. They're effectively, a portion of it's paying them with their own money. And then they have too much leverage. So they said they want to reduce their leverage. But one of the reasons we suggested the CO is like you want to reduce your leverage, but every quarter every month you're increasing your leverage by overpaying the distribution. And they say, well, it's small, but they're increasing your leverage. So the leverage is too high. They have some significant loans outstanding to a group called Westbank, which has been rumored to be bankrupt. They have, I think, around $250 million. Don't hold me to the exact number of loan on a large Vancouver property. They've been relying on getting that paid back to deal with some of the leverage. Questionable whether that's going to be achieved. They have this King Toronto development where they sold condos as high as $2,200 a square foot. Well, markets come way down. Allied has written it down, I believe, in their book to about $1,500. The question is, are those condos going to close? And they're relying on the cash for that to pay down their leverage. So they've lost two tenants coming up, McCain and NVIDIA, good tenants to Portland Commons in 2026. So there are some issues with Allied. We're neutral today because we recognize the sentiment of return to office. We're not sure to what degree that's going to benefit Allied versus some of the bank towers downtown, for example. But certainly the sentiment is a factor in public markets, and we're cautious on the name, but we're not bullish on Allied today.
So we were just talking about Mainstreet Equity, founder run, founder led, and Allied is not it's not run by faceless corporate executives. It's Michael Emery who started it. He's the chairman. He's kind of part of the DNA of Allied. And I'm sure real estate is a small circle. You've crossed paths or
sure.
So what do you know or what do you think about what he's trying to achieve here?
I think Michael's a very capable guy. We just have, as is his management team, Cecilia, we just think, and it's not just we think the board's responsibility here. We don't agree with their capital allocation decisions, and it's largely driven, in our view, trying to persuade, influence, one might say mislead retail investors by overpaying their distribution to keep the stock price up. And in our view, they're just not our view. I think it's factual. Just look at the accounting. They've been destroying value by doing this. Net asset value is coming down. Their IFRS valuation is way above what they've been bringing it down, but it's way above what the consensus view of analysts are of the net asset value, and certainly well above our view of value in terms of things like cap rates. So yeah, it's a challenging name, particularly at these levels. The stock's way up on this return to office sentiment.
I think it's interesting, though, that you're not going to short it at these levels, though, because sentiment is powerful. And a dividend of now 8.5% yield, as a short seller, you would have to carry that.
Yeah. So we have we use options. So we have a neutral position on the stock today because of the sentiment. We're pretty good at using options to diffuse risk.
Let's move to Artis REIT. This one is, we just spent a bunch of time on Allied and whatever. I feel like this almost needs a whole show. If you haven't been following what's gone on with Artis REIT, Alberta-based exposure here primarily, and they, I guess, are being taken over by a company called RFA Capital, but it's a complex deal. And even analysts, I was trying to understand, is this a premium? Is this a discount? Even analysts are kind of scratching their head as to, okay, what does this mean for what Artis now becomes? Because it will remain public, and RFA, which is buying it, is not a real estate company. It's almost more of a financial. Did I get?
Yeah, it's a business combination.
Yes.
And the future of Artis REIT will, as advertised, at least they're going to try not to be in the real estate business. So Artis generally has been a train wreck. We haven't been constructive on Artis. They have been in a asset disposition mode, also been overpaying their distribution, also have too much debt. So they've been trying to sell assets to pay down debt. Our sense is, well, they probably sold the lion's share of the assets they could sell at a reasonable level to be effective in paying down debt. They had an investment with Kanwar REIT, which is part of privatized, also a train wreck. I think that's virtually gone to zero today. Certainly some of their investments in the capital stack. This merger, it's not happened. It just got announced. Unitholders will have an opportunity to vote on it. I'd say that
just to focus us, the question from Nick on X was, how can we value the new entity? And will they be able to liquidate the existing portfolio of real estate assets at their net asset value?
So I'm going to objectively borrow some of the work from a good analyst in the street at Scotia, Mario Sarek. His analysis, which we tend to concur with, is this effectively will, at the end of the day, values this enterprise at 14 times earnings on the bank side. Now, that's what Royal Bank trades at. If they get everything right, and we'll come back to that, to the other part of the question, 14 times earnings. I mean, Equitable, also public, in the same space, much bigger than RFA, trades at 9 times. This is replete with conflicts. Yeah. The chairman and the CEO, which are old buddies, Chairman Ben Rodney is RFA Capital. The CEO is the CEO of Artis. And the answer to your viewer's question is no. I mean, one of the issues unitholders have to assess, again, borrowing on Scotia's work, is this transaction effectively equates to Artis selling at a 44% discount to the REIT's own IFRS net asset value of the units. So it suggests perhaps management may not be that confident in their own IFRS net asset value of proposing a transaction at that level. You're going to see this no longer be a REIT. Mm-hmm. So there's going to be impact. They're cutting the distribution. And as a result of no longer being in the REIT, it's going to have to come out of REIT indices. So, some of these folks are going to have to sell down. And it doesn't address the underlying issue at Artis REIT. They've been trying to sell assets to pay down debt for several years in order to lower the leverage and ensure the long-term viability. And this transaction doesn't facilitate any additional asset sales.
And just to add to that layer of related parties, Sandpiper, which owns 20% of this and says they're going to vote for the deal, is that the CEO's company or the chairman?
Correct. Yeah, that's Samir Manji is controls Sandpiper. What we've asked for to help unitholders objectively evaluate it is then you look at the RFA side. It's a bit of a black box. Unitholders need to understand the details of the loan book of what's in RFA today. We know Artis has challenged assets. We don't know about RFA. Are those loans on condos that are being sold? We don't know. And so when you see the circular, we're hopeful. We did approach the CEO of Artis, Mr. Manji, over the weekend, asking him to put this disclosure in the public realm. We'll see what kind of disclosures. But unitholders need to have this information to properly assess the opportunity of this business combination. It's a black box today.
And it sounds like for unitholders, is it kind of a lose-lose situation? Like how do they respond to something like this?
We're not one of them. It puts them in a tough place. So
I want to get to your pro picks because we've obviously there's a lot of landmines out there that you're not willing to touch. But I want to squeeze in one more in the mailbag because it's interesting. It sounds like you're constructive on this name. It's one of the few IPOs that we've gotten in this country, and it's GO Residential. And it didn't do particularly well in its IPO. It went out at $15 a share. It promptly went down to around $12 a share, where it's hanging out right now. It's not Canadian real estate exposure, but they chose to list in Canada, which is interesting. We got a question from Ian in Cambridge. Do you like GO Residential?
We do like GO. There's been a series of 100% U.S. property enterprises that have chosen to go public exclusively in Canada, for either because they were too small initially to get major research covered in the United States, or some of them had external management contracts, which Americans will tend to shy away. That's not Go. Go was the largest REIT IPO in Canadian history, and it's 5 assets, good assets in Manhattan.
Which you love.
Which we like. Luxury apartments in Manhattan. We've toured them all. At $15, the IPO price, this was valued at approximately a 5.8% cap rate, unlevered return in terms of real estate speak, 5.8. I mean, if you could buy an apartment building in Manhattan at a 4.5% cap rate, I think you'd be doing well. So we thought it was cheap, even though we've seen this history where these U.S. Cross-border IPOs have not done well coming out of the gate. And, Go certainly has not gone well. We questioned some of the equity capital markets representations that we made. I won't digress on that. In terms of the strength of the order book, what was suggested doesn't seem to be proving out in the market.
Meaning there were all these orders and maybe they were just flippers. They weren't long-term.
Correct. There wasn't supposed to be a lot of retail. I don't know exactly what happened, but it's been a disaster. This is a kind of thing Vision loves. Now, I don't know what the implied cap rate is today, but it's well over 6% for buying apartments
in Manhattan. Which is basically cap rate, just the income you expect on an annual basis relative to how much you purchase. Without leverage.
Right.
How much
so the unlevered return on the investment. And over the weekend, we just saw this morning a press release from Go that the sponsors wrote big checks, like, about 750,000 shares in one case, a million shares. That's real money on a $12 US stock. So they're aligned, they're competent, and all of these have been, they've been lousy out of the gate. You look at the history of them. Milestone REIT, Sunbelt Apartments, bought by Starwood. Pure Multifamily REIT, which we were activist on, was bought by Cortland Private Equity in the United States. We saw Blackstone buy Pure Industrial REIT. Then they sold a big chunk of its portfolio to another cross-border REIT, WPT Industrial REIT. And then 2 years later, they bought WPT Industrial REIT, both at premiums to net asset value. So Tricon, bought by Blackstone. So these have tended to be great investments over the long term because they're off the radar screen for Americans, and Canadians don't underwrite them properly. And yet it's real estate. You have that arbitrage. So if it doesn't work, and you're trading at 6.5% apartments and somebody wants to buy apartments in New York City, they can knock on Go Residential REIT's door. Right now, there's a bit of an overhang because the New York election on this name. That's what's hurting this stock, not just the capital markets, which was just went public the end of July. So it's really new. But you have the Mamdani election concern impacting. If
he gets elected, does that change your thesis?
Well, it would only be reasonably to assume that he's going to be elected at this juncture. So it doesn't change our thesis because we own it and we bought it with that knowledge. One of the attributes of Go is there's a proposal by the mayoral candidate to freeze the legal allowable rents. Not sure he's going to do that or he can do that. But even if he does, at Go, they can still increase rents because their rents are below the legal maximum in some of their core assets where this is an important factor. And that's not a long-term sustainable model for New York City either. So
each of these have such a fascinating story behind them. So great for a podcast. That's all we have, all the time we have for the mailbag, because I want to get to your high conviction ideas, your pro picks. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, let's get into your high conviction ideas. Your first one is Chartwell Retirement Residence. You've already said you love seniors housing. So you're picking Chartwell as kind of the horse that you're betting on in this segment. What do you love about it? And, the fact that it has run up, is that a deterrent to you at all in terms of valuation, whether it's trading at a premium?
It's not trading at a premium to our view of net asset value of this enterprise. And I would note one of the reasons we like Chartwell, and we'll talk about the sector, we like the sector generally in the United States and Canada, but you have comparable names in the United States trading at 50 to 90% premiums to net asset value. Real estate, so Welltower, which is a very large enterprise, it's trading like a high growth healthcare name, not a real estate name. Ventas trading at big premiums. So Chartwell, higher growth, the biggest player in Canada. Secular tailwinds are through the next 20 years in terms of aging of the population. Limited new supply. So 15 years ago, there was a lot of supply of retirement homes. Anybody that had a great real estate piece of land, they wanted to buy a retirement home. You can do the best real estate deal in the world. If you're not a strong operator, it's like hotels. It's primarily an operating related business. So Chartwell, as a largest and very capable operator, is really well positioned because there's no new supply. These folks learned their lessons. So supply and demand looks good. Value is quite reasonable. Leverage is conservative. Strong management team. And a year ago they came out, they said they were about 82% occupancy. They told the market they were going to be 95% by the end of 2025. The market was skeptical. We were not. They're like 94% today, and we think there's a likelihood they're going to exceed it.
You said the U.S. equivalents are trading at a 50 to 100% premium. Chartwell's trading at a discount.
Correct.
Is it your view that they should trade at a 50 to 100% premium, or that even a little bit of a adjustment to the U.S. peers is where you can get your upside?
I don't think they should trade at a 50 to 100% premium to NAV, but I do think this enterprise at this time frame, based on the very favorable fundamentals, warrants a premium for a number of reasons. And we saw Welltower by Amica earlier this year. I mean, it was private, so not a lot of disclosure. But if you were to apply the valuation metrics that Welltower bought Amica, which is Canadian retirement homes, I suspect that would be a very significant premium for Chartwell looking at their forward-looking net operating income outlook.
So stock trading at $19, already up 30% so far this year, and you see it. What's your net asset value, or it's?
We're at about $22.
Okay, so a bit of upside from
And
here.
you get a nice dividend while you wait.
Yes, 3%.
Yeah.
Dream Industrial REIT. We've talked about the Dream Complex. What do you like about what's happening at Dream Industrial, which has, it's perked up since April, let's call it that, but certainly not the same trajectory as a Chartwell?
No, I mean, this is a cheap stock. It's been hit by concerns over tariffs, and we'll come back to that. And bit of a pall on the sector. But what one needs to understand about Dream Industrial, they're in the industrial sector by definition of their name, is not manufacturers that are going to be hurt by tariffs. It's distribution related to our local economy. It's a very attractive dividend on this name. Don't ever buy REITs for yield. Total return is what counts, but the yield is part of that. 5.6% dividend yield. Stock is cheap. Our view of net asset value is around $17 per unit. So here you have a stock at $12.50 paying you a 5.6% distribution yield, that the value of the underlying real estate is $17. Well-managed enterprise. And we think, any improvement in the tariff picture is certainly a boost, but we didn't buy it relying on that. They have a great joint venture. I mentioned Summit earlier. Summit, this was bought by GIC, Government of Singapore Pension Plan, bought Summit. They partnered with Dream. There's the operating platform, so they're generating management fees on their GIC partnership. They're using GIC's balance sheet to grow. We think the stock is cheap, management is strong, and we think this continues to appreciate.
Your third pick, you love grocery anchored, so First Capital REIT kind of fits into that. And I'm curious how you think about holding this. You've mentioned certain sectors like office, not a buy and hold sector. Maybe you can catch it as a trade. And it looks like First Capital, over the last couple of years, it tends to top out at a certain level, call it $18, $19 a share, and then it pulls back. And now it's back to that $19 level. Why do you like First Capital as a theme? And then how do you think about how it maybe breaks out of its
So
range?
This is most of our core holdings at Vision are long-term core holdings, and this is certainly one of them. We've been pretty public on our conviction on this name for some time, and I've stated, and I'll state here, this is the highest quality grocery-anchored shopping center portfolio in the world. That's a bold statement.
That is a bold statement.
Even for Vision, that's a bold statement.
What makes it so?
So again, I have a long history in my former career leading financings for them, and I got to see this portfolio created. And it's created in the 6 major urban centers in Canada. Toronto, about 50% of Toronto. It's 75% Toronto, Montreal, Vancouver, rounded out by Calgary, Edmonton, Ottawa. There's no fashion here. There's no power centers here. There's no secondary markets here. So it's the best located shopping centers in the heart of 6 growing Canadian cities. They have stability from the grocery anchor. And as I mentioned earlier, the ancillary tenants are necessity-based. There's about 20 million square feet of in-place grocery-anchored shopping centers and 22 million square feet of incremental density to add value on those sites, not greenfield land, but in these locations. Now, that's not worth as much as it is a year ago because of the condo market, but long-term, it's part of the value to it. They've done a good job operationally recently. They've been increasing their net operating income. Their bad debt is down, and they're still trading at a discount. Supply and demand fundamentals strong. No new supply. There's been no new supply in this sector again. So demand resilient, grocery anchored really helps that.
I mean, this was a messy story for a while, and I believe you got involved. Did you get involved on the activist side? You and Manny Ewing Morris, who we've interviewed. Anson, I believe, was also involved.
Not sure about Anson, but
I could be wrong on that.
Sandpiper was involved.
Sandpiper, yes, that's the one. And Dory Siegel, of course, the founder and former CEO. So how did you get from your discontent with the company a few years ago to today?
Our view at the time, and we weren't front and center in that debate, Ewing Morris and Mr. Siegel and Sandpiper certain were, we tried to play more of a constructive role behind the scenes with board members we knew well, CEO we knew well, and it resulted in a 2023 cooperation agreement where people really understood Vision's involvement for the first time publicly on that day, where we brought Ewing Morris and First Capital together to have a positive resolution that resulted in a new chairman of the board. At that time, it resulted in Mr. Richard Nesbitt being appointed to the board. Richard, full disclosure, on our board, former president, Toronto Stock Exchange, former chairman and CEO of CIBC World Markets. And earlier that month, Ira Gluskin had been appointed to the board, who wasn't our nominee, but he's on our board as well. And so there was board change, and they addressed and announced what they called their capital optimization process, where they've been selling low-yielding assets with low income and redeploying that capital to reduce leverage, buy back some stock, and some of their growth initiatives. And so, that was a positive outcome at the time. We were very critical of some of the most, and have been critical about some of the worst capital allocation decisions we've seen, which was in 2019. The REIT levered up with a lot of debt to buy out major shareholder Gazette, which Mr. Siegel had been affiliated with, in order to get rid of the sponsorship. That was a dumb move. There was no accountability for that at any point in time. Wrong point in the cycle to add leverage. And they've been basically unwinding that for 5 years. And so we were critical of the board in some of the governance in capital, but the assets are amazing. The markets are great. And the real estate speaks for itself.
And an example of not a CEO change to catalyze that. Is that right?
That's correct.
CEO that you were unhappy with is still the CEO now.
That's correct.
But now you're on side with the things that they're doing.
Well, we still are active on the file. We still have governance concerns there, frankly. We were public at the annual meeting. So that's in the public realm. We think the board operates more of as many boards do, as a club. We've used that word. They don't like it, but it's I think a very...
So what changes would you like to see done?
We'd like to see more active shareholder aligned. There was a lot of interest in acquiring this REIT. The stock price has done well, and so that validates perhaps the governance path at the time. But there's a lot of interest in this asset class, and the debates we've had with some board members is that everybody knows we're for sale, Jeff. If somebody wanted to buy us, they come to see us. In my experience, both in what I've been doing for 18 years and as a banker for 15 years, it's a very different outcome when you have a process. It doesn't have to be publicly announced, but a process where people have some certainty of transaction versus it's motherhood. Every entrenched board you've ever says, of course, we're always receptive to a transaction. That's motherhood. It's irrelevant. When you have an independent investment banker managing a process and there's some certainty, like the Blackstones and Brookfields, they won't do anything unsolicited by corporate philosophy. So they need to be invited in to do a transaction where they have some confidence that if they spend the time and money, it's a lot of money, to go through these processes, at the end of the day, there's a reasonable likelihood there will be a transaction. The market does not have that confidence in First Capital.
And you'd like them to start that process?
I think they should have started a long time ago.
Jeff, this has been so fascinating. I feel like I could do another hour, but my producer, she's over there shaking her head. So great to get time with you. Thank you so much. I learned a lot.
Thank you for having me.
That's Jeff Olin joining us from Vision Capital. Don't miss our next episode. We are talking commodities, mining, oil and gas. We've got none other than Rick Rule rejoining the podcast. So get your questions in. We know he always gets a lot, so we'll do our best to get through all of them. Email us at questions@inthemoneypod.com, and we'll see you on the next episode.